Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about jobs, housing demand, the median homebuyer age, and what happens to mortgage rates if Trump's tariffs are struck down. As always, I want to thank our sponsor, Trust and Will, for making this episode possible. Logan, welcome back to the podcast.
It is wonderful to be here. I cannot express to you, this is going to be one of the more happier days on our podcast because I get to be nerdy chart daddy teacher today because there's a lot of different things to talk about. And I love it. When we get these nerdy days, I could really be myself today. So I'm very excited about today's podcast.
Well, that's great. Well, I was going to ask you, how does it feel to have a jobs week, another jobs week where we don't have the official Fed jobs data?
We don't have the government data, but there's enough other things to give us clues. I know you don't like me when I say this, but Mother Economics, she is a serial killer.
She's not.
And all serial killers want to be caught, and they will leave you clues. They'll leave you crumbs to follow them. And today was a good day on that side.
Okay, well, let's talk about that. What economic data are you looking at this week?
Okay, we're going to teach the slow dance, mortgage rates, bond yields, and everything because we always believe in channels. So when I talk about channels, waves, the upper end, I have to say it can't go much higher here unless the economy is booby. Or when we get down to 4% or a little bit below, boy, so much is priced in. And if the things don't get worse, bond yields should go up higher once you get better economic data. So when that happened with the Federal Reserve meeting, what do we say the day before? Powell's going to get hawkish. They don't like mortgage rates near 6%. They've always made a stand here. He got hawkish. The Fed president hawk groups, went hawkish last Friday too. Bond yields ticked up a little bit, but we haven't had any economic data. So today, the 10-year yield has gone up 7-8 basis points. We're at 416, 417. Mortgage pricing is only up 4 basis points, but still. What happened today that's different? We have two pieces of economic data that if you're somebody who was saying the US went into a recession 2 to 3 years ago, and it's just around the corner, which doesn't make sense with logic, because if you're in a recession and it's around the corner, that's just not how it works. In any case, you don't have new orders in the service sector data breakout. That's what happened today. We had the ISM service sector index for a service economy. The new orders ticked up. So very positive sign. But we also have the ADP report. Now, as crazy as this sounds, 42,000 jobs created is actually a beat. I know it sounds weird. It would have never been tolerated last year or 2 years ago or 3 years ago. But when Jerome Powell and the Fed hawk says, and this is the terminology they've used to give clues to the bond market, if things aren't getting worse, we're not cutting. So things didn't get worse because they were saying we see data in our regions and they're not getting worse. So 42,000 jobs created by ADP, which is the least valuable out of all the jobs they did, but that's all we got now, actually meant that the last 2 months being negative, the curve is higher, positive. New orders up, positive, right? These are things that don't happen when an economy is breaking. So because of that, bond yields have gone up. Right, it's 416. It's nothing like huge or anything like what we saw last year. Mortgage pricing up just a smidge today. But it shows you how the equilibrium between tracking live data, the 10-year yield, the mortgage rate, the slow dance that we've always talked about makes sense. And that's what I'm trying to do. I'm trying to make sense of the data, because if you have people that say we're in a recession or we're on a verge of a recession or it's around it doesn't make sense, right? But there are certain data lines that we as data miners, the true pilgrims in an unholy land, when you have recessions, growth slows down, industrial production slows down, retail sales slow down, wages go to jobless claims rise. We're not there yet. Softer, but not breaking.
Well, and this is the tough part because you said, mortgage rates tick back up. Not huge, but it's tough because, of course, no one wants to root against Americans or the American economy. But when it gets better, then rates go up, right?
That's how it's worked, Sarah, since the Peloponnesian War. And this is why we do waves and channels, so we can teach people that you got to track the economic data. My thing is that over the last few years, people are talking about, we're on a verge of a cost. By the way, Sarah, have you had a run on your bank? Has anybody
Nope.
seen it? Are we safe from the run on the banks this week that were supposed to happen because the media is not telling anybody that the repo market is breaking? We're going to have so much fun with this, Sarah, on the run on the banks in the national over the next year. It's going to be wonderful. But you know, policy matters, right? And if the Fed didn't do their 2 rate cuts, the 10-year yield to me is 435 to 470, right? In that range, that looks perfectly normal with Fed policy. We do have 2 more rate cuts into the system, so the curve is a little bit lower. So with the data that we saw today, it looks right because it gets so hard when we're below 4%. It gets so hard to break underneath that and stay lower unless the Fed gets dovish or the labor market starts to break more. So, and we've had these labor scares every single year. Gandalf line in 2023, the Hodor line in 2024, and this, we broke underneath 4%, but Fed gets a little bit hawkish, data proves a little bit, bond yields tick up. This is how economic cycles work.
Okay, speaking of that ADP jobs report, so yesterday we got, like 30,000 layoffs here, things like that. Why isn't that being, reflected yet?
Okay, so there's over 162 million people working. Over 160. Everyone get your calculator. Subtract 30,000, 40,000, 15,000. Okay, what do you get? Too small. Can't get the job done. 1.5 to 2 million people lose their job every single month, right? When economic growth slows down, consumption slows down, industrial production slows down, retail sales slow down, you're no longer keeping your employees, you're no longer hiring, you are laying off people. That's how recessions work. So every single month, 1.5 to 2. Could you imagine if we listed everyone that lost their job, right? On average, we don't talk about the jobs created, but people are like, oh my God, there's a recession. No, this happens all the time. I think this is the missing link on the economic discussions and what I've seen people use for 10 years. Oh, Amazon laid off 30,000 people. Well, so-and-so laid off 50,000 people 3 years ago. Too small, because when an economic cycle goes into that downturn, growth slows down and all these other data lines come down with it. You're no longer hiring anyone. You're no longer hoarding. You are laying off people as a totality. And that's how economic cycles work. And I think that's, I should have done a better job in the last decade talking about this. I've haphazardly talked about, jobless claims never goes to zero. People get laid off. But I really have to focus on this because these company headlines make people think that there's a big, the job growth is slowing down, but it's not breaking, because breaking, jobless claims rise, growth slows down, all these things work together. So we're not there yet. We're softening labor market, but not breaking.
Okay, so some news today. We are recording this on Wednesday, and the government lawyers are in front of the Supreme Court arguing about Trump's tariffs, and it doesn't look like they are going to side with Trump. They're giving him a pretty hard time. Of course, we don't know. We won't know something today, but what is your sense from that?
For all the WWF fans, I would bring the Undertaker's music on, and the more talks that happen on the Supreme Court hearings, the worse it is for Trump. I mean, and let's be realistic here. We're not having national security measures for the Lord of the Rings Fango forest trees coming and attacking America, right? For lumber, right? Where lumber is a national
Oh,
security.
okay,
Or
okay. I was like,
no,
where are we going with
yeah.
this?
So there's all these national securities, and it's questionable that all of a sudden do we have tariffs because the Canadians, did a Ronald Reagan ad, or we don't like how the, former president of Brazil is being treated. You got to question, in a court, is that really going to work? So the interesting aspect is bond yields are up today. As one market person said, hey, it's really interesting that Trump looks like he's going to lose his tariffs, but bond yields are going up. The economic data matters more, right? And I'm different than everyone. If there were no tariffs at all, if we didn't get the goods inflation and the prices paid on service rising, the Federal Reserve would have only cut 2 times, because they would say, we're still modestly restrictive. We have not got to our 2% target yet. I don't think you would have had much of a difference out there. I think the interesting aspect with this year with the tariffs and last year, the growth rate of inflation was falling, and then the jobs data started getting weaker. So the bond market went ballistic on sending yields lower, broke the Hodor line, which I didn't think it should have done, but it did. And then all of a sudden, things picked up again. Today, things picked up again, but 10-year old at 416, right? We're not, heading back. We're not at last year. We're at 7% plus mortgage rates already, right? So it's a different marketplace. But I think the economic data matters more tied to Fed policy. That's the thing. 65 to 75% is still Fed policy. So we work with the economic data. So I imagine if Trump loses the case, they're going to do out every other things, and we're just quite not there to get the whole tariff story away from us, because people say, well, the Federal Reserve said if there were no tariffs, they'd be cutting more. I question that premise, but that's the logic that the goods inflation that's been rising and the service sector paid inflation that's been rising, those things would come down with no tariffs. Okay, we'll cross that bridge when we get there. We're quite not there yet, but I still think the Federal Reserve would have been modestly restrictive with no tariffs. And the question is, have the tariffs slowed the job growth down because businesses don't know what the rules are, so nobody knows how much they want to put in. So there's all these variables that are a little bit tricky to track when you have government come in and changing policy and moving things around. And I get it. I mean, I lived through this in 2018 and 19, and I studied it. And I think if Trump wins again, man, he's going to go tariffs again. So we have to be a little bit more prepared on how to deal with it.
So I was at the Builders Daily Conference last week, and I was just at the Texas Mortgage Bankers Association conference yesterday. In both cases, they talked to builders. They had builders who were speaking who talked about the fact that a lot of their suppliers were eating the extra cost of tariffs, but that was going to end at some point. They couldn't keep doing that. And so, the builders have been feeling it, even if it hasn't affected their pricing yet. So that would be good news for builders if, for instance, tariffs were, cut down to where they were before. I don't exactly know. It's very hard at this point to know what tariffs would be impacted, what tariffs are even enforced right now. They've gone through a lot of changes, but it seems like that would be good news for builders and, inflationary because, it would boost business for everybody, not just the builders.
I disagree with that premise.
Okay, tell me why.
Only 7% of what the builders put into their homes are input costs from overseas. And when COVID was rampant, inflation was rampant, lumber was $1,700, and sales were doing very well. Why? Rates were lower. So right. If I had to do a paper, rock, scissors with the builders, I don't put much weight into this because the rate story matters more. And how do I know this? What data has seen an exceeded increase in confidence during kind of this period? It's the small builders confidence index looking out. Why did it get better? Because mortgage rates went down towards 6%. And how do we know this is valid? It's happened every time mortgage rates go down to 6%.
But Logan, I think it could be a both and, because they did say, one of the things they said was that they got a lot smarter and a lot more efficient through all the lessons they learned in COVID, that they, their supply chain is much different. They know where all those things come from. But they said up until now that, a lot of the vendors have been eating the suppliers have been eating some of the costs. They haven't passed those on yet. So why couldn't it be both?
Because I still think the rate, we had a burst of inflation. All the costs between garage doors, ring bells, lumber, everything, rates were lower. Builders just ran through it, So again, the builders are here to make money, and having extra pricing power. What did they do with extra pricing power? They shot the median sales price up very hard. They were canceling contracts on people and said, hey, you got to pay an extra $100,000 because our costs went up. Because they are here to make money. This is capitalism, right? Everyone go watch the movie Ghostbusters in the first scene of the movie where Dan Aykroyd tells Bill Murray, listen, this is not the public sector. If we work for a school, it's not working. The private sector, they expect results, right? So people are here to make money. So
But I don't think you and I are saying different things. I'm
no,
just saying that, like, this is good for the builders.
no, this can be good. I still think if the builders' costs went down and mortgage rates went up to 7.5%, that matters more. Even if there was no tariffs, even if there was disinflation on stuff they were importing, rates go up, sales go down, confidence goes down.
I don't disagree that rates are the most important thing there, but I'm just saying this could be, this could be good for builders, and I think just good for the overall economy. So therefore, it seems like that pushes rates up.
We shall take a look at this if rates ever go up and there's a disinflation for tariffs. Okay, we'll address that. But speaking of which, two other more topics: the LLPAs.
Yep.
Bill Pulte kind of
Wait. Before you say that, what is an LLPA? Because some people listening to this podcast don't know what that is.
Pricing, as pricing for rates.
Loan level price adjustments, right, is what it means.
Pulte says he's just going to call it pricing because it's easier that way. In any case, they increased some pricing under the Biden administration. So a lot of people thought, well, now with Trump and Pulte in there, they were going to lower some of that. My take has always been this: if they were staying in conservatorship, there's a lot of things you can do in conservatorship, right? But if you're going to an IPO and you're talking to bankers and everything, I'm not sure you have the free will to make really big changes because, again, you are selling a product. That product has to make as much money as it possibly can for shareholders. And that's why I'm always advocating keep them in conservatorship. They're way too big. They can do a lot of things. It's not going to cost the taxpayer or anybody. We're not raising taxes for whatever. I mean, they're making so much money, hands and fist. You can do a lot of things. But once you go in the IPO route, it becomes a little bit more complicated. So I think there was a lot of disappointment, I know, from people that thought, this could change. But it's much more difficult if you're going the IPO route.
I think that's interesting because we saw that, was it last week or yeah, I think it was just last week, Pulte, or maybe 2 weeks ago, Pulte was like, we've got Barry Habib, we're looking to him to give us a proposal. And he did, and we were pretty excited. I think everyone got excited because it would definitely lower some of those LLPAs. It was definitely from a lender perspective, a good deal. And then it's not that they said, oh, we're not going to take that, but they were like, we're looking at other options too. So it felt like the White House walked back, or Pulte walked back, like, this is the proposal we're going with.
Well, they brought out a picture about, the stock exchange and the great American company. It's November, right? We're in November now. The 5th of November. Oh, that was a good movie. V for Vendetta. You ever see V for Vendetta?
I don't know.
Oh,
I don't remember.
We're going to have to watch that. It's a very good flick.
V for Vendetta.
But so I understand how people are disappointed, but we just, if it's going to IPO, man, they're going to have to do some numbers and stuff like that. So, again, at this point of the economic cycle, I would have just let it go. I would just keep them in conservatorship, do the IPO thing a little bit later, change the LLPAs, get things running, right? Make America great again, right? Go for it. Take the advantage that you can, but that's not the route they obviously chose.
Okay, our last subject is purchase apps, because here we are on Wednesday again. What did they show us, and where is your model right now?
So purchase application data down 1% week to week, up 26% year over year. That's the highest growth in recent weeks. I think 25% might have been the previous week. The days of the very low comps on purchase application data are coming to an end, right? When we went into this year, one of the themes is, like, guys, this is an extremely low bar. This is, I was a high school basketball coach when purchase application data was this low. So when you're working from a very low bar, you have to be mindful of percentage increases, especially if new listings data grows. More people are selling their homes. They have to fill out an application. So the data does not mean the demand is really picking up, because we went from mid 1990s to 2014 levels within a year. That's a big jump, but that doesn't mean sales are going up 700,000-800,000. That's the tricky thing about purchase application data. But we probably have just 2 to 3 more weeks, and that's it. The low bar is over. These year-over-year growth prints that we've had, that I think it's like 40 weeks now of year-over-year growth, and like 28 weeks of double-digit year-over-year growth. Those comps are going to be going away soon, and then we work off of really what the focus should be, the weekly data. right? The week-to-week data, 8 positive, 6 negative, 14 straight weeks of double digit. That's the best 14 weeks we've had here, but it's not like what we saw, let's say late 2022. Late 2022 had no purchase application data year-over-year growth, but it had 12 straight weeks of positive. And it gave us one of the biggest month-to-month sales prints in history. Almost 500,000 homes went into one report. Okay, so if rates go from 6.64 head to 6, just stay there. You got something to work with. So it's a positive curve out there, but again, it's purchase apps is very confusing. So I get it. I'm trying my best to teach people this, but this year was one of those years where the last few years we had negative year-over-year data, but we're seeing sales growth. Here, we get a little bit more growth on a year-over-year basis. We're working from a low bar, but the purchase application data on a year-over-year basis looks like, whoa, out there. And just remember, most sellers are home buyers. List your house, fill out that application. You still need that mortgage buyer to come to take that house off. You sell that, you go buy another one. That's how the transaction model works, right? That's why mortgage demand is so key.
So do you think that we get those extra one or
No,
200,000
no.
this
I
year?
mean, I mean, not, we need 12 to 14 weeks of weekly positive data. We don't have that yet. We only have 8.
Okay.
So the curve maybe could get a little bit lower, but we were working from a very low bar last year. So with a couple 100,000 that we did grow, we were working from a couple 100,000 a little bit lower on that side. So the growth picked up. Once you get 12 to 14 weeks, you can go off with it. But for that topic, moving to the last thing we want to talk about, the NAR's median first-time homebuyer age. This gets a lot of play on social media because it looks like only old people are buying homes. And basically, you're like 40-year-old virgin movie, it's the guy that's buying a house because you have to be
Right.
40 years old. Okay, so I'm going to say this because I'm going to get really, really nerdy. If you look at how the NAR collects that data, I think they sent out 173,000 mails out there for people that bought a house between June of 2024 to June of 2025. And only 6,000 people filled out the survey. There's 120 questions out there, man. If you want to do surveys, man, you put a lot of questions, you're not going to get it very high. So the only
That's a lot of questions.
there's only 3.5% people accepted and filled it out and brought it back. So I'm not saying the data is bad, but one of the things that looks really funky to me is that the NAR's first-time home buyers on the yearly survey is at 21%. Okay. Well, on the month-to-month data in their existing home sales report, their first-time home buyer has been moving between 27 and 33% for like 14 years. Right.
Okay.
So there's something a little bit that's not aggregating. Like if you take one data line from a survey, I'm not a big fan of surveys, but people do them. You have to verify it with other data lines. Like the NAR has there's not many distressed sellers out there. Okay. That survey is only like 50, 60, 70,000 people. But I can look at the FHFA, the ICE, I can look at all these credit data and they all come together. I'm not saying take the data with a grain of salt, but just be a little bit mindful that these are very, very small surveys. And I do believe that the age, my whole work in the last decade was that we're going to have the weakest housing recovery from 2008 to 2019. The first-time home buyer has to work its household formation. The household formation process takes longer, right? Because we rent, we date, we mate, we get married. 3.5 years after marriage, we have kids. We do things a little bit later in life, right? We get married later in life. If you look at the marriage ages going back decades, we just get married later, we have kids later. So years 2020 to 2024 will have a more healthy backdrop for millennials. And millennials started buying in 2013. They were the biggest home buyers in the world. So the survey is a little bit iffy, if a 3.5% a response rate. So if it gets a little bit of volatile out there, like if mortgage demand picks up, rates go down, and more first time, that small pool can bring the age down. I don't believe that really happened. If it did, it's a small survey response.
Yeah, I appreciate that context. So is there another data set? You talked about how you could, back test other data. Is there other data for medium home sale, the age?
The New York Fed has been tracking this for a while, and they've kind of said first-time home buyers have kind of been at the same age for a very long time, like 30 to 35,
Okay.
and that looks more correct to me, just because of the timeline of marriage and everything out there. So, of course, over 93% plus of young people buy their homes through financing. For when mortgage demand goes, that variable falls down a lot. So the data could get very volatile, right? And of course, affordability matters, of course, but it's one of these things that if we saw mortgage demand pick up, out of that small response, you could get more first-time home buyers and that number could fall down. I don't think that's valid either. So kind of look at, people just do things a little bit later in life, and affordability matters and mortgage demand matters, and go with that. But the survey in terms of first-time home buyers being at 21%, and then all of a sudden your monthly data has been basically, the last few months have been like 28 to 31%. So it looks funky, but I thought I need to explain that because it's a very small survey. Once people saw the survey, like how they track it, they're like, wait a second, really? Is that it? And that's why I say that always read how people get a survey. I'm not the biggest fan on surveys. I'd rather have like real authentic data. Like credit data is awesome because you get to carry, but hopefully that explains that data line, that divergence between the NAR's monthly sales numbers and their yearly surveys.
Super interesting. Logan, thank you so much for walking us through all of those things, even on a week when we don't have federal
Yes,
data.
Chart Daddy became a teacher today. My favorite. It was a lot of fun. There's a lot of things to talk about.
All right. Thanks, Logan. Talk again soon.